series. Paul is via satellite today. Paul, how are you? Frank, how are you? And we're going to talk financials now. This is big
Right.
game, right, Frank?
That's right.
We're going to be throwing people to the wolves today as our guest. And I did call out the last one. I still believe AI singularity will be 5 years. It might be earlier if Elon Musk had to do with it. But our guest today is Jordan Roy-Byrne. And Jordan is going to talk about specifically the greatest bull market in gold and silver has begun. So, Jordan, thanks for stopping by. I don't have a clue. I bet you Frank buys gold. I sure as hell have not bought gold or silver. Maybe it's been in one of my financial plans. So I'm ready to be educated by you, Jordan. Thanks for stopping by.
Well, it's my pleasure. Thanks so much for having me on. I'm looking forward to the discussion.
All right, I'm going to throw Frank him to the wolves. Right then, you're already kind of developing questions. I'm going to throw a question out that this is going to be a little controversial in a way. The market right now, should we be scared? I don't think we should. I think we're going to see a comeback, and everyone is kind of jumping to conclusions with the market right now.
Yeah, I would agree with you. I think in the short term, we're probably going to get a rebound at some point, and maybe even if we can avoid a recession this year, maybe the market can make another move higher over the next few years before it runs into more trouble.
And that's key because this is not interesting. Frank, your thoughts, and Paul. I want Paul's thoughts on this too. Paul, do you think we shouldn't worry about the market right now? And this is just a kind of just a little bit of a
Well, for me, the theory about the market is the long term, right? I mean, it's always about keeping it and getting through from whatever problems it's going to come back up. I mean, that's the long term strategy that everybody seems to have. Um, yeah, I'm totally interested in what you're looking at, Jordan, is for gold and silver. I see here that maybe there's a difference now that gold used to be the thing to buy, and now it's maybe silver. Is that what you're thinking?
Not necessarily. Silver is essentially a leverage play on gold. I mean, people like to talk about it and that it's kind of more interesting and fascinating because it has the industrial angle. And so industrial demand for silver has really picked up. But at the same time, investment demand for silver, and you usually don't see both those sides of demand going up at the same time. Usually one is going up, the other's going sideways. So both are going up. People love to talk about the industrial demand. However, really at the bottom line, silver is just a leverage play on gold. So if you want to invest in precious metals, gold is always safer because silver is more volatile on both sides. So silver can make very extreme moves in either direction. And ultimately, when gold rises, and if it's a steady, consistent rise, silver will pick up and actually outperform gold. And I was just looking at this yesterday. Silver has been a little bit, not a little bit, silver has been disappointing because at this point, given the move in gold, up basically 50% in the last 12 months or so, or last 13 months. Silver has not, I don't have the percentage handy, but silver has not done as well. Normally, if gold's up 50% in a year, you would think, oh, well, silver will be up 100% or more than that. I mean, it is a bit of an opportunity. So silver has underperformed and underachieved to this point. But that's how I think about gold and silver. Gold, much safer, more consistent when it's in a secular bull market. Silver is kind of the wild card and more of a leverage play.
interesting.
Gotcha.
And so here's my take on the market and looking at specific things is ultimately, do you believe in really being conservative when you invest or be aggressive investor?
Well, it depends on the person. So it's so difficult for me to say what is right because every person is different. I mean, one thing I will say is that, which I talk about in my book, is that markets move in secular trends, 15 to 20-year trend. Now for bonds, bonds were going up for 38 years from 1982 to 2020. So that's a huge game changer. In the last 100 years, from 1920 until COVID, basically, there was only one period in there basically from the early 60s to early 80s, where interest rates were rising and bond prices were declining. And so after COVID, that broke below my secular trend indicators. And I think most people would agree with that. Bonds are in a secular bear market now. And that is a huge sea change as far as what most people are used to, because bonds have been rising or were rising for almost 40 years. I mean, that is multiple generations. So, I mean, you have that. And then at the same time, uh, stocks and hard assets, which gold is a granddaddy of hard assets or commodities, there can be some overlap, and we have seen some overlap in recent years. But for the most part, if one's going up for 10 or 15 years, the other is going sideways or down. So they take turns alternating between these secular trends. Again, there are some historical examples of an overlap, and that's what we've seen in recent years because gold made a new all-time high. That's really rare, considering stocks are still in this long-term uptrend in a secular bull market. But I get back to secular trends because if you think about the mid 1960s to the early 1980s, if you look at the total real return for equities from 1963 to 1982, it was zero. That's you're including dividends, you're dividing by inflation. That's all basically a 20-year period where it was zero. You can look at, I mean, 64 to 83 or 63 to 82, something like that. So when you're in an inflationary period, again, we've only had one of these in the last 100 years. Over up to 20 years, stocks do zero. So the problem with, I mean, I do agree, stocks for the long run. I mean, that's great, but uh, people at this point are really going to need to diversify because we're early in what could be a long secular inflationary period, and they're really deceptive because kind of at the beginning, stocks can still do well, but when you kind of get to the middle and you get towards the latter half of it, inflation really starts to bite you. It really starts to hurt share prices, and then at the same time, when inflation really sets in, valuations come down, and so that's why at
Yep.
the end of these periods, stocks get super super cheap. So again, I do agree with stocks for the long run, but in this case, where we are here and now, not U.S. stocks.
Okay. So do you believe the stock market? And then I'll let you, Frank, ask a question. Is it easier to pick the stock market or gamble on sporting events without
Uh,
having mutual funds or different or 401ks where there's multiple funds and different things? What do you think's a better, which is less risk?
well, I mean, I would go with picking stock markets, but trying to predict, I will say this, trying to predict things in the short term, like if we're thinking of what's going to happen with the economy or macro or where stock prices might go over the next year or so. Now that is really really difficult, and so that nobody gets that right consistently. But I'm just stepping back and looking at major trends and valuations, which predict long-term returns. You can be more accurate with your expectations on that time frame.
Okay. Go ahead, Frank, with your question.
Well, as far as the stock market's concerned, like I said, I was in a brokerage firm right before the Dow hit 1,000. That's how far back I was working there. And I asked the stockbroker there, what should I do about stock? What should I do? It was in my 30s, late 30s or so. And he said, you buy stocks and you keep them until you get a long gray beard. He was right. Over the long haul, from 1,000 and whatnot, what is it, 41,000? But anyway, gold. I got into gold right after the blow up the gold. What was it, 650 or 850? And then I got into that then at that time and taught myself technical analysis, what have you. And I've been in and out of the gold market, the commodities market, and learned a lot. And I just think that I have a good feel as where the support levels are and what have you. Because you can look at the price of gold and try to decide what it's going to do by using technical analysis, which is very important. Or you could look at the fundamentals, right? And both are affected that way. But I think the fundamentals affected the technical analysis. But at any rate, yeah, I think everybody should have gold. I think 10% of your portfolio should be in precious metals, period. And when I was selling gold back in the 1970s, late 70s, the investors would say, what's the price of gold today? And I said, I don't know. I don't look at the price of gold every day. Right? You shouldn't either. You should buy the gold, stick it somewhere, and leave it alone. and over the long haul, it's going to go up. Okay, how long? I don't know, but and I don't even follow the price of gold, unless you're a day trader or a technical an investor that's a trader as opposed to as different than an investor. So I wanted to ask you one thing though, Jordan. I can't remember the name of the technique or the technical analysis technique. It begins with an F, something Fujiyama, something or other, and
Um,
cycle. There's this big cycle that starts from way back when, 30s and all the way up, and you're watching the cycle as
oh,
it
is
goes
it
down.
Kondratiev wave or point and figure charts? F doesn't ring a bell for me. I'm sorry.
But he showed the cycle. The top's here, then it goes down to here, then the top here, then it goes down to there. And then what we've done now is that we bottomed out and that there's no guessing where this is going to go. It could go to who knows what. Okay. So it's up on a big upswing over a period of years. I was looking at $3,000 goal of like for 3 to 5 years. And that changed quickly. Okay, now like we got the gold in a couple of years, $3,000 gold in a couple of years. So where it's going to go after that, I don't know. It's definitely going to go up. Okay, there'll be corrections, but you're not going to see $2,000 gold again. You're not going to see $2,500 gold again. Okay, you might see $2,800 gold again if something happens. But on the long haul, it's going to go up. And like I say, if people that here want to know what to do with your portfolio, take 10% of your portfolio, put it in the precious metals, and take physical possession of them, please. Don't leave them stranded somewhere. And take physical possession of them, put them in a safe deposit box or whatever you want to do, and just leave it there. And then and it's a good hedge against what's going on with the currencies and what's going on in the events in the world or what have you. So I don't know. Do you agree with that? At least a certain percentage, no matter what the reason, in your precious metals?
Yeah, I mean, I agree with most of what you said. I am a technical analyst by trade as well, so I understand what you're talking about. One thing I'll mention is I should pull this up because I keep mentioning in interviews. I did see someone who is not a gold fan. They did mention that they looked at a study that said, oh, how much gold do you need in your portfolio, where it really is a good diversifier. And I think they mentioned it was at least 20%. So sometimes when you hear people say, oh, 5% or 10%, it sounds like a cop out. But stepping back, my big issue is markets move in really long-term trends, as you know.
Right.
When gold made the huge move in the 70s, stocks were going sideways. Same thing in the 2000s, and that's what what I think is going to happen over the next decade and 15 years. Stocks are going to go sideways for a long time, while gold and hard assets will move higher. It doesn't mean every single month or every year or two they're going to move higher, but stepping back and looking at the 50,000-foot view, that's what I see coming over the next 10 to 15 years. And that's why people should be invested in gold, because they're at least US stocks. I mean, maybe they can diversify with some foreign stocks. That's a way where you can kind of avoid the US stock market without having to put all of that in gold. Foreign stocks are really cheap. Emerging market stocks are really cheap. But yeah, that aside, I'm most concerned with these big picture trends over the next decade or two. And that's why I'm so optimistic about gold and hard assets and less so about US stocks.
So Jordan, why are you out there coming out? Do you have something you're promoting right now? What's the reason to come out as an analyst talking about specifically gold and silver?
Well, I do have a new book. People can get that for free at my website, thedailygold.com/book. Yeah, so I'm giving away a free PDF and EPUB file. It is a real book. They can see that. So that's what I'm promoting. That's kind of all my work and research, again, wrapped into one book.
Do you have a business, or how do you, like, you as an analyst? Do you help people with gold and silver and how to invest it?
Yes, I do consulting for some people. I also write and publish my own newsletter where I talk about the companies that I'm investing in. So I do like to invest in these smaller, very risky companies that in a gold and silver bull market, they can really leverage your gains. If you're not careful, you can also lose your shirt. So I do have things that I try and do to minimize losses, while trying to make huge gains at the same time. But in the last few years, I mean, I have, I've been doing it for, almost, or investing in gold and silver for almost 20 years. So I've learned a lot. I've, lost a lot at certain times. So I have a good sense of what to do and what not to do. And, looking at these smaller mining companies, which are called junior mining companies, you just need to there's 3,000 or 5,000 of them. You just need to completely ignore 95% of them and look at the small ones where management has a track record. They're really doing something serious. The project that they're working on is pretty good. I mean, they have a real plan to, build mines and grow their business and also sink capital back into the ground to try and find more gold. So in my newsletter, I mean, those are the things that I focus
Right.
on, which I do have a chapter on that in the book, but most of the book is kind of my bigger picture analysis as far as, this is about the gold and silver market. This is some history. This is a history of long-term trends, and this is why they're going to go much, much higher in the next decade or so.
So what is your average percent gains in the market every year for yourself?
Well, I mean, we have, gold in the last, or I should say from 2020 to 23, it did go sideways. So those weren't great years. I mean, I think last year, I mean, I may have been up 50% or something like that. I mean, I haven't looked at it exactly, but last year was a really, really good year because gold broke out of a 13-year pattern. Um, as Frank knows. And so that was super bullish, and that's why it's up 50% in the last 12 months. But in the last year or so, I mean, I've learned I'm really just trying to pick the right companies and companies that are good investments, even if, metals prices were static or were around current levels.
Mm.
Because that's the problem that you can get into is you could think, okay, well, I'm just going to look for anything, and if gold's going to go to 5,000, this company will, I'll make 20 times my money. That could be risky. So, I'm mostly focused on the smaller companies, but they're established that I think have huge potential to really grow in this bull market. So that's more my focus than less so like performance numbers and that sort of thing.
Got it. Frank, and the last question for Jordan.
No, just one little thing that I learned in the strategy. We talked a little bit about those penny stocks, penny mining stocks. I had a broker years ago that somebody recommended to, and he was, he deals in those. And he said that I said, well, which ones are going to be good? I said, I tell you, that's not the strategy you use. When you go into something like penny stocks, it was really cheap. Penny mining stocks. These were gold stocks. He said you pick about 12 of them, all right? And you invest X amount of dollar in 12 of them. And one or two of them, the others will go bust. One or two of them will take off. And will pay back everything you put in plus your advance. And I thought that was a great strategy. I did it, and sure enough, we picked up about 6 to 10 penny stocks, and one of them came in really good. Was from 2 cents to $3, which that made up for all the ones that went down or went bust. So anyway, just want to throw that at that as an interesting investment strategy that I experienced.
Wow.
Yeah, no, that's great because I've experienced the same thing. I mean, I invested in lots of private companies, and some have done really well. And I do have one or two silver ones, which they're coming public shortly, which should be big wins, for me and my investors. But I will say, at the same time, investing in some of those, I was a little too selective because I'm not a fan of the shotgun strategy. And one of my brokers was telling me, you really need to have a shotgun strategy where you just invest in 10 and you put in a small amount in every one. And I was looking at these ones, and because I was too selective, one of the last ones I looked at a few years ago, I said no to it. And I think the deal was or the financing was at 20 cents. I said no to it. And, the stock is like at $4 or $5 now. They made this great discovery. And it's exactly to your point. Like, if you want to be too picky about picking stocks, that doesn't work when you're going really low on the food chain and you're looking at these penny stocks. Of course, you're not just blindly throwing money into any penny stocks. I mean, you're taking a look at all of these and maybe you'll pick 5 or 10 ones that you like versus a bunch that you don't like. But yeah, you really need to have that shotgun strategy because one or two are really, really going to pay off. And so unfortunately for me, in this last round a few years ago, I didn't want to take that strategy. And because of that, I said no to this company it's made a huge discovery, and it's probably one of the 3 or 4 best of these junior mining, junior exploration companies in the last 4 or 5 years. I mean, there's not that doesn't come around where there's 5 or 10 of these every year that do that, as you probably know. I mean, there might be 1 or 2 if you're lucky. So I know exactly what you're talking about.
All right. Well, fantastic. Best place we can pick up your book, Jordan. Where can we go?
Oh, they can go to my website, thedailygold.com. Just opt in there at the top, and it's free.
All right. Thanks, Jordan. Appreciate it.